Thank you all for joining this month's afterMATH webinar. It's always a little bit odd doing it on a Monday morning, but that's just the way the way the calendar kind of works out when we have the crop reports on a Friday. It doesn't happen every week like that or every month, but this month it did once again. So with that, just kind of kicking off, we'll look at the numbers from last week's USDA report on Friday. We'll start there, and then we'll kind of go back and look at each crop and look at the markets and some things that we're thinking, at least at this point in time. As far as the numbers last week, as expected, USDA did not make any changes to the corn and the soybean production numbers other than accounting for the different acreage numbers that they had put out back on June 30th. So they did not change the yields, still showing a 178.5 corn yield, still using a 49.8 bushel bean yield. But the change in the corn acres down from 97 to 92 million took almost 1 billion bushels, about 900 million bushels off the production side of things. So that was certainly a bullish factor in the market following that June 30th report. The market had already worked that acreage number in. So really the production estimates in this report didn't really make much difference in the overall reaction to the report. Now, what did were a few of the changes to ending stocks. USDA raised the old crop corn stock number to 2.248 billion bushels. They did cut demand, as was maybe expected or feared or whatever. They also did the same with soybeans and did the same with wheat. All three reduced demand, increased ending stocks a little bit. In the new crop, carrying over, we'll talk about this with corn especially in a little bit, but the corn stocks at 2.648 billion bushels. If you're a bull, you would say, well, that's not the 3.3 billion we were talking about a month ago, but it is still a big number historically. And so if this crop does come out the way it's being projected right now, and demand continues to be a little bit iffy, we could still be looking at close to 3 billion bushels when it's all said and done. Soybean stocks, that's a positive, I think, here, that bean stocks down at 425 million bushels. That was up from last month, but still, if the Chinese demand continues, I think that's a positive for beans going forward, or at least opens the door. Wheat, ending stocks expected to drop this year again because of lower production. At the world level, not too much to read into too much of this. We'll talk about beans here in a little bit, but the wheat one's the really big one here. 314, almost 315 million metric tons of wheat. And USDA definitely assuming we're going to see good Southern Hemisphere production, still at least counting on good Black Sea region, good EU production, as well as the US and Canada. So if everybody hits this year on wheat, which it looks like right now that people will have good wheat crops around the world, we're going to build these stocks numbers back up to a big number once again, and we'll talk about that when we look at wheat here in just a few minutes. As far as crop progress, these are a week old. We'll get the updated numbers this afternoon, but as of last week, 10% of the U.S. corn crop was silking. That's just slightly behind normal. The crop rating had dipped last week to 71% good to excellent. I would tend to think today's number will probably be down another point or two from that. We'll see which areas got rain last week and did it have any impact on the crop. What's USDA's read on that? But I would think another point or two down. Soybeans, 31% of the bean crop blooming. They're actually running ahead of normal, 7 points as of last week. 71% of the crop was rated good to excellent a week ago. That was unchanged. Winter wheat harvest still runs at or a little bit ahead of normal. And the crop rating there has been slipping a little bit the last few weeks. And you can see some of the other crops. Spring wheat doing just almost right at normal pace. Pretty good ratings as of right now. Cotton running right at an average pace as well for this time of the year. Now, looking at weather right now, we do have some areas of concern. Last week's drought monitor does continue to show the southern plains as an area that a lot of people are focusing on. The panhandles of Texas and Oklahoma and up into Kansas, Colorado, and even into Nebraska. Very dry and very hot right now. We've seen some additional drought showing up in the eastern corn belt in Indiana, Ohio, even a little bit in Illinois. We've seen some severity increasing in western Iowa over the last week, as well as up into Minnesota. And we saw the drought monitor continue to show some in the upper plains. Now, as far as what's happened over the last 2 weeks, here's a picture of rainfall. So that northern territory has gotten a lot better situation in the last couple of weeks with rainfall. We've seen plentiful rainfall in Minnesota, Wisconsin, as well as down in the southern states during this time as well. The areas of concern, I mentioned the drought monitor a minute ago, as we look into western and southern Iowa, the eastern belt, Indiana, Ohio, and then down into the southern plains. Even though some of these parts got a little bit of rain, still not enough to alleviate the dry conditions. The soil moisture, this kind of relates to the drought monitor, I guess, just another way to look at it, but it does at least show you the areas that are wet as well. We've seen more than plentiful rainfall on the eastern seaboard, and that's had the Carolinas especially very wet, the Delta staying very wet right now. We mentioned a minute ago that Minnesota, Wisconsin's had plenty of rain during this 2-week window, so they continue to be on the moist side. But you continue to see the southern plains, the western belt, the areas in Indiana as well that continue to be struggling for soil moisture right now. So what's going to happen in the forecast? Not a lot of rain in the west. We do expect to see over the next 5 days parts of the Corn Belt getting some decent rain. We'll watch this part of Iowa to see if the dry spots get rain over that period. Some of the drier areas in central Illinois expected to get a little precip. Maybe that's going to linger on into Indiana, at least northern Indiana, give them some moisture as well during this 5-day window. So a lot of some haves, a lot of have-nots in the 5-day period. But what's really got the market reeling, I think, this morning is you come back from the weekend, and we were looking at these extended forecast maps, a lot different last night than what we were looking at on Friday. Friday, everything was hot and dry. The heat is still expected to stick around. The 6 to 10-day forecast continues to call for much above normal temperatures, especially down in the very dry areas of the southern plains. But the forecast has changed in much of the country to show above normal precip in the 6 to 10-day window. And then the 8 to 14-day forecast even shows more green on the screen. So you're looking at the eastern half of the country and parts of the northern plains as well. So that's a lot better, a lot different situation than what we were looking at when we went home on Friday night. I think that's what's triggering some selling across the market here this morning. Now, the weeks 3 and 4 forecast, these are experimental models, continue to call for hot and dry. So if we don't get that rainfall in that 8 to 14-day window, maybe the market's got another push behind it again. We'll see if that happens or not. But right now, the seasonal tendency is for the markets to trade lower right now if you're talking rain in this time of the year. And so right now we're seeing certainly some of that bloom taken off the market. So the extended forecast, this is about 3 weeks old. We'll get the next one next week. But the August, September, October 90-day outlook continues to call for warm temperatures. So you would tend to think that's going to speed a lot of these crops up. Probably going to have an early harvest in a lot of areas. I know we were behind getting the crop planted in many areas of the country this year, and you would assume that with the hot forecast expected through August and September that's going to push this crop along pretty fast. So now we do have some areas expected again to stay fairly moist during that period. So that might be helpful to the bean crop, especially in Iowa, if this does happen during that period. So looking at the commodity markets right now, things have kind of stabilized. This is the commodity index, the CRB index, goes back to the beginning of the year. You can see the plunge that we took, the COVID plunge, whatever you want to call it here, from March through April, made our lows into late April. And since then, commodities have kind of evened back out again. And this is driven mostly by the oil market because we'd seen oil go from $40-50 a barrel down to sub-zero in the spot market. Now we're back up trading around $40 a barrel. So that's the biggest driver in the CRB index, but you've seen the grain markets kind of moderate, move back up as well during this period. But as far as changes go, since we had this meeting last month, I thought this was kind of interesting. In fact, I updated this again this morning due to the changes overnight, but December corn is down a nickel from where we were on June the 12th. Beans are up a couple pennies. Chicago wheat's up 23 cents, while the Minnesota and Kansas City markets are down. December cotton up almost a nickel, and the rice market just a tad lower during this monthly period. So awfully mixed trade. So with that, we'll start with corn. And, the biggest challenge the corn market has this time of the year, I know there's a lot of people that are waiting for a rally. I know we were trying to get a lot of corn sold at the end of June. I think there was a lot of corn priced at the end of June, a lot of old crop corn, a lot of corn that was on basis contracts, on elevator storage. The people didn't want to renew. So I think that with this we'll show the fund positions in a minute, but I think the big buying run that the funds went on was offset by a lot of producers selling. And but this is the time of the year where it's hard to get people convinced to buy. And you can see where we're at here. We're second week of July now, and this is the time over the last 20 years where the market tends to trend on lower into the fall. And so you're going to have to really show the market some sort of damage, some severe weather situation, I think, to get this market to really rally at this time of the year. And whether you look at a 30-year, this is a 20-year seasonal chart, you can look at the 10, you can look at the 15, you can even look at the 5. And most of these years, we make our highs in June. And once you get past the 4th of July, you've really got to prove something to get the market to run. You've got to go back really to 2012, the last time that happened, and that was, of course, a very severe situation. So looking at the balance sheet from last week, I kind of gave you the highlights a minute ago. Probably the biggest detrimental factor, first of all, we knew that production was going to drop because of the drop in the acres. But probably the biggest negative was feed demand. USDA, which is kind of a surprise given that I think animal numbers are still hanging in and we're feeding to heavier weights right now. But USDA projecting a smaller gain, if you will, in this year as well as in next year's feed demand. And so maybe expecting less new cattle on feed, new hogs on feed, whatever, as we go forward. Ethanol demand was kind of mixed, a little bit lower in the old crop, a little bit higher in the new. But USDA raised ending stocks for this current year to 2.248 billion bushels. That's basically where we were last year at this time, going into the end of the year. And it's kind of interesting that average farm price within a penny of last year. So, pretty much the same situation, different year. Looking ahead, forecast is for ending stocks at 2.648 billion bushels. As I mentioned earlier, that's down from the 3.3 billion that we were talking about here a month ago, but it's still a big number. And this stocks to usage ratio, I put a star next to that, 18.1%. That's the biggest since 2005. So before we were talking the biggest since 1988. So it's still a 15-year high in stocks to usage ratio. And I still think that the problems that we may have might come in this export number right here. 2.15 billion bushels exported. USDA is projecting that number to be 400 million higher this year. That seems to be a stretch to me. We'll see if it can happen. But we're projecting a bigger feed number. We're projecting a bigger rebound in ethanol. But that big export number seems to be a stretch. So I would think that there's a chance that number could eventually come down. I know there's a lot of people that are going to be suspect of whether we can grow a 178.5 crop or not. And I would tend to think that, given what I know today, that the yield maybe would slip a little bit, but you could also see USDA lower the export number a little bit as well. So I really don't see it's going to take an extreme weather situation to get stocks below 2.5 billion at this point. And consequently, lower prices probably being projected. USDA projecting an average farm price at $3.35. That is up 15 cents from last month. They were at $3.20 a month ago. We'll talk about that a little later when we look at PLC and ARC payments, but certainly 25 cents down from this past year. So what can happen ahead? This is the stocks matrix that I like to use to be able to look at what it takes to get stocks down to a certain level, what it's going to take to move it. So on the left-hand side, we start out with 92 million acres. That's USDA's number for now. What I've done then is multiply by different percentages of harvested to come out with different harvested acres. Right now, USDA projects only 91.3% of our planted acres to be harvested this year. That's relatively low. Usually 92% is about average. So not quite sure why they're projecting a lower number, probably down in the Southwest where we're seeing some drought situations. We're going to start out, the government says, at 2.248 billion bushels of corn, and they're saying we're going to use over 14.6 billion bushels this year. So if I look at a 178 yield with USDA's acreage, we come up with carryout this coming year, what USDA says, at 2.648 billion bushels. So what does it take to get the market to really get bullish? Assuming we have 84 million harvested acres, you're going to have a yield of 174 or below to get down to this year's stock number, probably 173 and a half. So I think that's your starting point. If you want to try to get the market to be friendly or to be bullish, you probably have to get down to a 173 or below yield. Can that happen? Maybe, but I think we've got to see some, you're going to have to see some severe weather impact on this crop in order to get that to happen. I don't think it's going to happen this month. We'll see what happens with the crop ratings. Watch those every Monday afternoon. We'll get the updated numbers this afternoon. So we'll see if that has any impact on the market tomorrow. As far as ethanol, the good and the bad. The good is that ethanol demand, I think, has its highest number in 15 weeks this past week, or ethanol grind, ethanol production. Ethanol stocks did bump back up a little bit this past week after dropping, so we've seen good blending. But still, you can notice where we're at relative to the last 10 years, and we're still only, the seventh highest year that we've had as of last week, and we're still well below where we've been the last 3 to 4 years. So ethanol's got a long way to go. And so go back to the balance sheet. USDA projecting current year at 4.85 billion bushels. They did lower that a little bit in this last report. Seems about right now. But they're projecting it to come back to 5.2 billion this next year. So we're going to have to continue to see that curve continue to climb here as we go forward. So looking at the charts, we've had a heck of a run in corn over the last 8-9 weeks. You go back to the beginning of May, we've traded spot corn down to $3 a bushel, traded all the way up to about $3.50 here in the spot contract last week before the markets have dipped here at the beginning of this week. So percentage-wise, that was a big move. It's a seasonal type rally that we tend to see, and hopefully we were all able to take advantage of some of it. I'm a couple days late having this webinar as far as trying to help you take advantage of a rally because the markets are behind us now. But if you read the market report that I write every day, last week and a half or so, I put in some different things about min-max contracts, different ways to take advantage of the market when we get these rallies. The funds gave us the opportunity. They were short over 280,000 contracts just a few weeks ago. They were only short 142,000 as of the middle of last week. And they did buy a little bit as well Wednesday and Thursday ahead of that USDA report. So I think they were within 100,000 of even going into that report on Friday. And certainly they were big sellers on Friday, and they've been big sellers again here overnight. And if you look at the trend over the last 5 years from now through fall, typically it's sideways to lower, that the funds are sellers this time of year from now into the harvest period. So, as I mentioned way back at the beginning, it's difficult to get the corn market to rally from July to really October, knowing that, that the crop gets made and it gets harvested and people start selling. So, and we're going to see a lot of old crop corn get sold as well. And I think that's one of the big features we've seen the last couple of years. As you get to the end of August, 1st September, we've seen a lot of old crop corn get dumped. And that's the scenario that still has me most nervous about the corn market as we go forward, as we get to the end of August, especially, that we could see a lot of old crop corn get sold and to make room for the new crop. But that along with some fund selling could keep some pressure on this market. So unless we see a weather market really jump back in, Dees corn is kind of selling off, if you will. And we did gap lower on the chart this morning in the overnight trade. So you can see what happened last few weeks or last couple of weeks. We'd gone from 322 at the end of the month. We got the bullish surprise on acres at the end of June, which rallied corn. We got a couple day move up into the 360 area on the December contract, but it wasn't able to stay there very long. And when we had the cuts in demand in Friday's report, that really was the impetus for the sell-off here on Friday. And so here we are back down below 340 this morning on the D's contract. And I know this is a busy chart, and I've explained this before, but I got all these crop insurance lines on here really to try to show, how your crop insurance policy is protecting you. Now, that's making the assumption of an average yield for either you or the county, but you can see that we're down, now we're down below the SCO line, or over 14% on price from the revenue price was set back in February. So anybody with supplemental coverage, if your county had an average yield this year, you'd be looking at a potential for an indemnity payment if the price goes down. And you can see the margin protection policy at a 15% loss in price. We're below that right now as well. So we rallied back above it. And, at this point last week, you were kind of on your own as far as having to protect price. Now we're back to where the policy is giving you at least some sort of protection. The other thing I would point out here, the RSI at the bottom at 45 stochastics lines are turned over right now, which tells me that we're probably going to see a little more downside of this market. So can this 3.25 area hold us? Maybe short term. Probably depends how much selling we have in the old crop as we get into August, whether or not we continue to go down and make new lows this fall. So as far as markets go, if I had to target something today, a rebound back to close to the 350 area, that's the purple line here, the 100-day moving average. If you're able to get back to 345 to 350, I'd probably want to sell it or do something with a min-max or something like that to be able to defend the price if that happens. Last week, and this was about a little over a week ago, about 11 days ago, but this is what I had written going into the weekend before the 4th of July. We wrote about this on all of the crops, but at that point in time, you had the RSI, the relative strength index was 68 on December corn, and the short-term stochastics looked like they were nearing overbought. So what we were looking at that point was buying a 340 put option, selling a 390 call. The net cost of that trade would have been a nickel a bushel. So if you go back and look at the chart, you would have had a floor at 340. Here we are below that here this morning. So I think that those are good types of trades to be able to utilize if you're nervous about selling a crop and you just don't know what you're going to have. Then these at least allow you to be able to do something. So I certainly, if you hadn't sold anything yet, it would make you, at least want to be selling some as well. But I like these types of strategies in a year where acres are big, carryout's big, the odds of a big rally are not great. So if I'm willing to sell a call option to take a ceiling and collect that premium to use to buy my put option, I think that those are decent trades. And at that point, that would have cost a nickel a bushel to do it. Looking ahead to 21, we've had a couple of opportunities to sell 380 corn over the last couple of weeks. I don't think anybody gets real excited about it, but it still might look like a pretty good deal. We still have some acres that are unaccounted for. I'm still wondering where 7 million acres went this year. I think prevent plant's going to be maybe a little bit bigger than what I thought it was going to be originally. But even if we had 3 to 4 million prevented plant acres, I still think we're losing, 4 or 5 million acres that are they're scratching my head about. So that's going to try to get planted next year, whether it's corn or soybeans. I really think beans are going to try to buy acres, but I still think in this 380 to 390 window, from 380, the recent high, 391 is the 200-day moving average. I would probably look to try to defend that price with something, whether it's a straight hedge, whether it's, again, a min-max type trade, something like that. I think it still makes sense to me to look at doing if that happens. So something to keep an eye on here as we go forward. Soybeans. The big story, if there was one, I think, was Brazil, actually, in this last report. The U.S. numbers didn't tell us a whole lot, but USDA did raise the Brazilian bean crop to 126 million tons. That's up 2 million tons from the last month's estimate and would be a new record high. And, oh, by the way, USDA projects Brazil to raise 131 million tons next year. So we're going to continue to see their acreage expand, it looks like, down there. We're expecting a bigger corn crop as well next year. So not a very pleasant set of numbers on the Brazilian side of things from USDA here. And what's going to cause us trouble will be the Brazilian real currency. It has bounced back a little bit over the last month or so, but still trading at relatively low levels versus the US dollar. So as long as that continues to be the case, we're going to continue to have a battle on our hands as far as trying to compete with South America. Now, Brazilian exports, you can see the impact of that lower real currency. They're having a banner year in 2020. Granted, China's been renewing their buying. They've stepped back in to kind of fill their bins, if you want to call it that, after last year's setback. But still, they're buying a lot of these beans out of Brazil, and it makes sense given how cheap the beans are. So looking at the U.S. balance sheet, the positive news has been on the domestic side of things. We're seeing heavier hog numbers. We're seeing heavier feed numbers. Crush numbers are higher. USDA bumped the old crop crush, bumped the new crop crush. They did make a strange change to the residual column. They lowered residual demand 50 million bushels. And I'm assuming that must be a change to last year's production. I haven't read anything that would explain that. But usually when they change a residual demand this late in the marketing year, it means they think that they called last year's crop too big. And so the net of that was an increase in stocks up to 620 million bushels. They also increased the average farm price of nickel to $8.55. Keep that in mind. We'll talk about ARC and PLC after a while. Looking ahead to the new crop, USDA did plug in its slight bump in acres, not a big bump, only to 83.8 million acres. Did take production up slightly. They did offset part of that with a change, with an increase in the crush, but ending stocks were up about 30 million bushels to 425 million. Now, I could make a case that that's kind of bullish. When you look at the last 2 years especially, and you look back 3 years ago, we carried out about the same amount of beans and we had an average farm price over $9. So you could make a case that this is a little bit friendly to the bean market longer term. That if something especially happens to the crop here in the U.S. in August, it might be a little more likely to see the bean market bounce than we are corn. And I did get asked that question last week on a radio question, is which crop do you think's got the best chance to rally? I think the beans probably do at this point, just because of how far into the growing season we are with corn right now. And we know we've got plenty of acres and we know we've got plenty of beginning stocks. Beans, when we're looking at, even with 7.7 million more acres this year, we're going to need all of that if China continues to buy the U.S. beans. USDA is forecasting over 2 billion bushels of demand. So if that happens, it still means that we're going to have to do a good job of getting this crop in the bin. And so if you look at the stocks matrix, which I showed you with corn, but we got some different harvested acreage numbers on the left. We got different yields at the top. USDA says we're going to use 4.343 billion bushels of beans next year. To get down in the low threes, you only got to take about a bushel off the bean yield from where USDA is at right now to get below 350 million. And so, I'm not saying it's going to happen, but, I think there's a lot riding on this August weather. And the bean fill as we get into the later part of the season. So again, maybe beans have more potential than corn does at this point in time. We'll see. So looking at the charts, it's been a heck of a rally. Beans have rallied over $1 a bushel off the low in the spot market. Keep in mind, the spot market back when this low was made was the May contract. It was at the end of April. And now here we are at the beginning of July. It's the July contract. Tomorrow, we're going to flip over to the August contract as the lead contract. And so we're trading a little bit below $9 a bushel here this morning. Support, probably the 100 and the 50-day moving average around 880. So we'll see if that can hold. That's about a dime below where the trade's at here right now. As far as a target, I guess if you get old crop beans to sell, probably looking at this 929 level, the 200 week moving average. That's been a top for this market for going back 2 years now. And so I would, if you got any old beans and you're speculating on a weather market here in August, I guess, 25, 30 cents might be about it. All I would be looking for. The funds, probably a little bit detrimental to a rally right now. They were long almost 100,000 contracts of beans as of the middle of last week. Now, I know they've sold some on Friday, sold some more here this morning. So I'll be really curious to see this next week's Commitment of Traders report, how much they've whittled that away. But again, you can kind of tell over the last 5 years, they don't tend to be a lot on the long side of the market this time of the year. We've had some, but we've also had a couple of years, especially 18 and 19, the last 2 years, where this time of the year they tend to be on the short side. So we'll see. But if they have sold this off, then that would mean that they do have a little buying power in case we do see some sort of a weather market. Looking ahead to the fall 20 crop, we've taken about half of the rally from the June acreage report off as of this morning. But again, the bean market really not dropping like corn has. The RSI is at 50, so we're kind of the middle of the road right now. Stochastics are turned over, which might mean we could see some more selling. But I'll be really curious to see how we close today. If we can hold this 20-day moving average at 882 3/4, might be a kind of a big deal here for the bean market. And if that's able to hold, and we'll see what happens to the crop ratings numbers out this afternoon. But again, I'm not horribly bearish the bean market right now. You can see a couple times the RSI has been over 70, and in fact, the RSI was at 70 here just a few days ago when beans went over $9. And so it was a sell signal. The stochastics turned over again. So again, really telling us that we should have been doing something to defend the market here just a few days back. And we failed to get through the 200-day moving average up here at 912. So maybe another reason why this market would, in hindsight, it's always pretty good, but another reason why that would have been a good area to be doing something with some beans. I did send this out a week ago in the last week. That I forget which day, the 7th, I believe it was. So it would have been last Tuesday when the RSI was up to that level. But I had suggested raising your floor on November beans, buying at 880 put, selling a 960 call. The net cost that day was 2 cents a bushel. So you could have had a net floor at 878 and a ceiling at 958. And again, you go back to the chart, or you can see the chart up here, having a floor at 880, which is right where the 20-day moving average is at, and taking a ceiling up here at about 960, way above the market, seemed to me a fairly prudent thing to do. So again, hindsight's 2020, but if you read the market report, those are the kinds of things that we try to look for those opportunities. And we circled the RSI here that day when we were up to 70, 71, that it was a time that we should have been taking some action. Looking ahead to next year, I'm kind of intrigued by $9 beans still in the Nov 21 contract. I still think it's a good hedge. We've had a couple of times the RSI has pushed into overbought territory, including last week when we got to 903, which was right at the 200-day moving average in this contract, and we slipped back down again. But if there's downside in the corn market, you're thinking you got D's corn in the 330s, but you got beans close to $9. I still think beans are going to try to buy some acres next year. And so whether that means corn price goes down, beans stay up, whatever. But if that's the case, I think I want to reward the bean market. And so $9, given the fact that we think South America could have a big production year, given that acres, I would tend to think U.S. bean acres are going to increase a year from now. I think down the road, a $9 hedge looks like a pretty good place to have something sold. So that would be my guess, my target. I'm probably not going to go crazy selling huge percentages, but if I were to sell 10, 20% of the crop each time we get up to 9 or above, not a bad place to get some hedged. The wheat market, probably the big story in wheat is world stocks. And I mentioned back at the beginning that we've seen numerous countries, USDA forecasting big production, and Australia, the big one that's going to rebound this year after 2 straight drought years, and consequently USDA forecasting a big jump in world stocks of wheat. So not what we need to have happen if we're going to try to rally the wheat market. Now the U.S. balance sheet doesn't look quite as bad, but USDA did raise the old crop ending stock. They lowered the feed demand. I think it was about 80 million bushels in this last report. So that was a big change there, evidently figuring we're going to feed cheap corn, and consequently raised ending stocks of wheat. The final market year average price is $4.58. That is the final number. Wheat's marketing year ended June 30th, so that's the number that gets used for PLC and ARC payments. Looking ahead to this year, harvested acres down about 500,000 from this past year. Yield right now being forecasted down as well. So even with a reduction in demand, we are going to see stocks projected to be below 1 billion bushels finally. And so that might be slightly positive to the U.S. market. But again, we've got these this other competition from around the world. As far as U.S. production right now, USDA did make a few tweaks to its numbers. They did lower the overall production. Hard red winter wheat yield was down. That was the big one. Soft red down just slightly. But certainly the areas in Kansas, Oklahoma, Texas, seeing its wheat yields shaved off here at the end of the crop year. Funds right now, short 33,000 contracts of wheat, which, historically they might be long, the last few years about right now, but they don't really stay there for very long. So I don't really think that there's, this is kind of a negligible position as of today. So looking at each of the wheats, the September Chicago wheat has had a nice rally. We're 68 cents from the low to the high. And even this morning in its trade, we're still above 530. Now, you can see the RSI at 64. Stochastic starting to turn over, probably a sell signal here in wheat. So if I've got old crop wheat to sell, whether I'm harvesting, just got done harvesting, maybe I look at the carry, and I don't have any charts on the carry in here this morning, but look at what you can earn by selling out to the December or the March contract for next year. Might be some pretty good revenue to be made by storing and holding the wheat market. But it's been a nice rally. We're at the 200-day moving average at 535. Unable to hold through that at a nightly close. So I think this is a good place to be looking at liquidating some wheat here today. Kansas City wheat, not quite as rosy of a picture. The RSI is only in the 50s, and stochastics kind of flattening out a little bit. I had hoped we could trade back up to around the 470 area, the 100-day moving average. Couldn't quite get to that level. That said, if I were going to be a seller of Chicago, I'd probably be a seller of some Kansas City as well. So as long as the world situation continues to look a little bit bleak, I think this 450 to 460 area probably makes sense to be doing some selling. Minneapolis wheat, I'd probably want to sit tight here, given that I do have my crop insurance policy at 457 base price. So if the wheat market does trade lower, at least I've got some protection there. RSI at 51. So given the fact that the crop's still in the field, I'm probably not going to get too excited just yet. But if I get up around the 540 area, which was the recent high, and it's also just below the 200-day moving average, probably be a seller. So 15 to 20 cents probably makes sense to be doing some selling here ahead of harvest on the September Minneapolis contract. Looking ahead to next year, the July Chicago, Kansas City charts, Chicago, we're trading right at the 200-day moving average or just below it at 536 3/4 this morning. Stochastic lines would indicate this market might be getting a little toppy right now. So, probably don't get crazy, but I wouldn't mind going out and hedging a little bit of next year wheat. Certainly, we're not too far below $5.50. Not a bad level to get started. Kansas City, I'd like to be able to sell $5 wheat. We're 486 here this morning. So $5 is the 100-day moving average, and the 502 is the 200-day. 496 was the recent high. You get back up close to 5, I think that probably makes sense to be doing a little hedging there as well. So another dime on this market, I'd probably start to get something sold for next year as well. Cotton's been the rosy spot, or the rosy market, I guess, if you want to look at it, the chart wise. It's and we'll look at that here in just a second. But the supply demand numbers, USDA first of all did raise export demand slightly in the old crop, which was a little bit of surprise. Took stocks down to 7.1 million bales, which is still a very, very burdensome number, just not quite as big as it was last month. But on the new crop side, we shaved planted acres way down. We took harvested acres down. We took the yield down 5 pounds in this report. So production dropped 2 million bales from 19.5 to 17.5 million bales from what we were using last month. Take that down to the bottom line, ending stocks at 6.8 million. We were looking at 8 million bales a month ago. So it's a positive from that standpoint, at least the change side of things. It's not a real tight number by any means, but I still think that there's a lot of us that think that this harvested acreage and yield numbers are both somewhat in jeopardy right now, given the weather that we're seeing in the panhandles of Texas and Oklahoma, and the heat that we're expected to get over the next few weeks. I would tend to think that there's a chance that those numbers could come down. We'll look at the crop rating on cotton here this afternoon. But when I look at my stocks matrix of cotton, 80% 820 pounds at 10.25 million acres harvested, 6.8 million bales. To get real friendly, it does look difficult here. You get below 790 pounds, now you're down below 6 million bales. It's still a big carry out. So production's going to have some impact on price. The other side of things is going to be export demand, and we really need to see that side of it pick up. And go back to the slide before, USDA did lower that to 15 million bales in this last report. So that's, we got two things working here. We've got lower production. That seems to be the trend, but lower demand also seems to be weighing, kind of holding the market back a little bit. But you look at the weekly chart, still pretty interesting. And I should have drawn a line across here from all these highs. Would be really interesting. We right really at a it's got a kind of a soft downtrend, and we're pushing right up against that right now, right here about 65 cents. You would hope that we could trade back up at least to the 100-day moving average at 67, almost 68, still 2 or 3 cents away. The 200-day moving average at 72. It would take, I think, a fairly severe weather situation to get us back there. But it's been a nice rally off the low. We're 16 cents off the spring low, the COVID low. The technical indicators are starting to push into overbought territory. And this is a weekly chart, so it takes quite a bit to get the RSI up to overbought, but the stochastics lines are pushing there as well. So, we're probably getting to a point where we need to be looking at defending the market. I did mention that. I'll show you here what I wrote last week. Looking at the DEES contract, we've gone from 50 cents to 65. We're right at the 200-day moving average. The RSI is above 70, or was at the end of last week. Stochastics lines all, to me, indicate this market's probably pretty toppy right now. Last week on Tuesday, same as soybeans, I had written about December cotton, buying a 63-cent put, selling a 65-cent call at a half-cent net cost. And so the 63 would have put you a floor at this red line right here, which is pretty close to where the market's at. If I was willing to take a ceiling at 65, right above the recent high, that's not a big range, but for only a half cent a bushel, I could have something set there. And, if the weather turns, better, if we do raise a decent crop, if, maybe you call that China insurance, if China, starts getting cantankerous again, and we don't sell them any cotton, whatever the case is, if the Southeast Asian market slows down, and more than anything, just the technical indicators, it was time to be doing something to defend this market. So I would look to be doing something like that. If you didn't want to hedge cotton at 63, 64 cents, maybe you look at buying the put, selling the call. If you trade back down around this 59 to 60 cent area where we had the lows in late June, then maybe I spin back out of that trade, lift it and basically lift my hedge and wait for some sort of an upside rally again. But I think it makes sense, just if nothing else, because of these technical indicators, because of the RSI and stochastics, to be doing something to defend the downside right now. Looking ahead to next year, pretty similar looking chart. In fact, you had the RSI up into the 74, 75 range last week when we made the high over 64 cents. I don't think any of us get too excited about those price levels for next year, but I do think, thinking ahead to next year, I would think acreage will try to be higher than what acres were this year. And I think, given the fact that you just don't see that many of these spikes during a year's time, the last time that we really had the RSI at a high for a few days was back in January when we were trading 70-cent cotton. And we did the same thing here just in the last few days. So I think it kind of makes sense to be doing some defending of price here. We have this nice trend line that continues to support the market down around 59 to 60 cents. Maybe you hedge cotton at 64, you get down to 60, you lift your hedge. Maybe it's just that, that simple to do, but at least take advantage of the rallies when we get them. The livestock markets, finally, the big factor, I think, right now in hogs and cattle are the heavy weight numbers that are going to market right now. This had a lot to do with the shutdown or slow down a lot of our plants this spring, and we're still fighting that. I think that we've got these heavyweight hogs, these heavyweight cattle that are still dragging out, and it takes a while to work those through the system. And I'm not so sure that our plants are still fully back up and functioning and going to stay fully functioning. So that being the case, it's just hard to get these markets to rally much. You can see the RSI here on hogs over the last, few weeks. It's just been a very, very flat market. We did have our little bump here, our little post-COVID bump in early May when we got a little excited about the plants coming back up online. But again, now we're fighting these heavy numbers, and that's what's kind of keeping this market under pressure. Same with live cattle to some extent, although the market has been able to bounce back a little. We're pushing up against the $100 mark in the nearby market. We got the RSI at about 48, 49, so pretty flat trade right now. I guess I would look at the 100-day moving average, the purple line. If you're looking at nearby cattle, up around $110, $112, probably be a good hedging target. Feeders have had a little bit better time than the fat numbers have, but still we're kind of topping out, it looks like, around this 50-week moving average, around 135. The 100-week is at 140, so not much above where we're at today. From 140 to 150, which was the high back in last fall, probably be some targets there if you're looking at selling feeder cattle. And the RSI and stochastics still pointing higher. Stochastics maybe getting a little bit toppy here right now on the weekly chart. So as far as going forward, weather is going to be the major market factor here for the next few days, few weeks. We're in a weather market. We'll watch the crop ratings on Monday afternoon. We'll get an August crop report next month, and that'll be the first time that USDA really looks at yield for this year. More than likely, they don't really look at crop condition in the August report. Most of the time, it's more about the populations than it is about the condition at that point. Europe and Asian weather, we had a little wheat rally last week. It lasted one day. We talked about dry EU weather, dry Black Sea region weather. That kind of went away. U.S.-China relations kind of come and go, it seems like, every day, but that's going to be a big factor. As we get closer to the election, it's going to be a factor. So we'll watch that certainly with one eye open. And then the seasonal trends. The trend right now is lower this time of the year from July into the fall. So it does take something pretty severe weather related to get the market to rally. And so that's going to be difficult to get the funds convinced that it's time to go buy ag futures this time of the year. Revenue insurance, I've showed this slide each month, but keep in mind that your revenue policy does work as a price put option. So if price does work lower, you do have some protection from it. You also have a yield put option as well as a price call option. If for some reason we have a year where the price goes up in the fall, you get your guarantee recalculated using that fall price. But this year, certainly the big factor right now is price. And so when you look at something like the corn market, I mentioned this earlier, but with the drop in price, some of these higher level policies, 85% margin, or you look at a 95% margin protection policy, we're down 10% from that trigger right now on price. The SCO coverage right now starting to be at a point where it's kicking in some protection as well. So you do have that put option. It does depend on your yields on your farm, or on the county. But if price continues to drop, you do have that price protection in your policy. We talked about margin protection just a second ago. Anybody that bought 95% coverage, a 5% loss in price, you only had to have price go to 383 to start to trigger a payment. What does that mean? Well, this is our margin indemnity calculator. And so we've set the harvest prices or the final prices for urea, DAP, potash, and diesel. The only thing we still have open is the county yield, the price of corn, and the interest rate futures. And those get set in October. But this is as of Friday night's close. And if I assume that my county was going to have an average yield at a $3.45 corn price, we were looking at an $84 indemnity payment on margin protection right now. Now, this morning, we've got the price of corn down below $3.40. So that's going to raise this indemnity, probably going to push this up over $100 an acre. But what this also shows on this calculator is down at the bottom where you can compare revenue protection. And what really sticks out with margin protection coverage is it's got a 95% trigger. You can buy 95% coverage, where with revenue protection, you can only buy 80 75, 80, 75, etc. And right now, based on price alone, we're not below the 85% trigger to trigger an RP policy payment on 85%. So that's the value of this margin protection insurance. I know for some of you, depending on where you're at, it would not be cost effective. But if you're in the Corn Belt states, it's a pretty decent way, especially for price, to be able to get some extra coverage, having that 95% coverage level. We are going to start setting the base prices August 15th for next year, for the 21 year. So August 15 to Sep 14, if we're able to hold that price up around 375 to 380, might not be a bad place to be considering this policy, kind of like we talked about hedging earlier or doing something to defend that price. We'll talk about that here in the August meeting when we get together a month from now. Also, did want to mention we do have our products, R-Powered and M-Powered. Those allow you to set your price for the 21 insurance now if you wish. Maybe today's not the day to do it, but if we get a rally like we just had last week, you get up to 380 corn, you can utilize this program to be able to lock that in. And they show here on this sheet that historically, this window, that we've had, the May, June, July window, a year in advance is actually the highest period that we tend to see for our insurance prices. You can do it again. We tend to see a rally again the next year, and then we trade on lower into the fall. So, but something to keep in mind, if we do get a rally here on the 21 market or on the 20, don't forget about the 21 crop as well. And I guess this just shows what I showed you a minute ago, but you've got this period here in the fall, in the summer of the previous year. You got the summer period next year, you tend to see a rally, and then the markets tend to trade on lower. The other thing that I showed you last month, and I wanted to show it again, is the carry in the corn market right now. And another reason to maybe be considering selling or hedging out into that 21 year, not only just for the 21 crop, but even your 20 crop. If you got storage and you can hold the crop, we've seen that carry for 12 months, from one year to the next. That Dees to Dees went out to 35 cents just a few days, 2 weeks ago, prior to the June acreage report. But even since that June acreage report, we've seen the carry kind of bottom and start to widen back out again. So a lot of this is going to depend on the size of the corn crop. But if we're looking at a 30+ cent year-to-year carry, good opportunities to earn money by storing the crop. And so if you're hedging Dees 20 corn, maybe you got a sale of Dees 20 corn off last week at 350. You might be able to roll that out to next December 380. Store your crop until the end of next summer and deliver it at that time or something. So there are ways to make money on the carry in this market. And so if you've got some hedges on the Dees 20 crop, be looking at those carry opportunities. And if the spread widens back out, maybe you don't have to go all the way to Dees. Maybe you just go to July or something like that. But there's some money to be made there in this carry. And again, we showed you this a second ago, but Dees 21, we did get to 380 3/4 last week. So we are down below 370 right now. But the R-Powered and the M-Powered tools allow you to lock that product in, or lock that price in for next year's insurance. If the February price ends up higher, you get to use it. For margin protection, if the August-September price ends up higher, you get to use that instead. But if you get this one day or this spike where maybe you get up around 390, maybe that's what you want to look at trying to do. So we'll talk about that in the market report as we go forward. Farm programs, don't forget about the CFAP program, the coronavirus program. If you haven't filed for those payments yet, you should get that done. The average payment on corn is 33.5 cents a bushel. You can see on down, soybeans close to 50 cents, cattle, hogs, some big numbers there as well. Don't forget to get those filed. 80% is the advance payment that you receive. And I did see another comment from the secretary over the weekend that he said we will get the rest of those payments made. So I'm not sure what the timing is, but the intent is there to get that done. Here's a look at the form. It's pretty simple form to look at. Your crop insurance agent most likely will help you with that if you need to get your production numbers to plug on there. Looking ahead to the ARC and PLC numbers, we did see some changes to the market year average price estimates in this report last week. The green numbers in these gold boxes were prices that went up. The red numbers went down a little bit. And so you can see that corn, soybeans saw prices bump a little bit. USDA did lower the wheat average a couple pennies on the old crop, and they did take the rice numbers down. Again, the crops that are highlighted in gold are the ones that would currently be triggering a PLC payment. Those prices are below the blue prices on the left-hand side of the page. So for example, if I go through the math on this, right now for wheat, we know that that was the final price for the year on wheat at $5.48. If you sign up for PLC for the 2019 crop year, you'd be getting 92 cents a bushel. Multiply that by your payment yield on your farm times 85% of your base acres. This example here would get over $30 an acre if I signed up for PLC on my wheat. Keep in mind that any crop that I enroll in the PLC program, I do have the opportunity to add the supplemental coverage option to my policy on insurance. SCO is an 86% county-based coverage, starts at 86, goes down to your individual level of protection. So for example, on wheat, let's say I bought 75% revenue policy on my farm, I could have an additional 11 percentage points of SCO county level coverage. And I can do that if I've enrolled into the PLC program at the FSA office. For corn, right now we're still looking at a dime payment for this past last year's crop, assuming that price stays at $3.60, and if you go through the math, it comes out to about $12-13 an acre. So not a huge payment, but we would be looking at some payment as long as we see that price stay below $3.70. The marketing year ends August 31st, so we still got a couple months left between now and the end of the year. Sorghum, looking at a substantial payment, 70 cents a bushel. Doing the math in this example, I come out to about $47 an acre. The cotton seed, we don't have the final or the most recent updated MYA price, but as of last month, we were looking at over 6 cents on cotton seed times my payment yield. I'd be looking at almost $100 an acre cotton seed payment. So we'll update those here when we get those here in a couple of days. For the ARC program, for ARC on corn, you would have had to have a loss in bushels because the price did go down from 370 benchmark to 360 estimated this year. So go through the formula for that. You'd have to take your 5-year Olympic average yield times 370, gives you your benchmark revenue times 86%, gives us a county revenue trigger at $477. If I divide the price into that, the current estimated price, my county yield in this county would have had to fall below 132.5. So in other words, we'd have had to have a 17.5 bushel loss in the county yield. Farm Doc did the work for us last month, and this hasn't changed. The price is still $3.50. The green counties would be ones that would have triggered ARC payments last year. So those are counties that saw a substantial drop in bushels relative to the 5-year average. For soybeans, the one thing that made soybeans look better for the ARC program, again, was this drop in the MYA price. The fact that we started with a benchmark at 963, but right now USDA forecasting the market year average at 855. And so when you do the math on this, you'd only had to have a county yield loss of 1.6 bushels to start to trigger an ARC payment for the 19 crop. And again, the Farm Doc folks did this, and you see all the green counties on this map. A lot of counties around the country that would have been triggering ARC payments given where the current prices are. So again, we've got 2 months left before those prices are final. We'll figure out where they end up landing. But as of today, we would assume that ARC is going to pay quite a bit of money in quite a few places for last year. Looking ahead to 20, and these prices, by the way, don't start officially being set until September 1st. So the marketing year runs SEP 1 this next year all the way through next August 31st. But USDA is currently forecasting a price next year at $3.35. And if that were to be the case, we would be looking at a 35-cent payment on the PLC program. Multiply that times your payment yield on your farm times 85% of my base acres. Keep in mind these all pay on base acres. I'd be looking at close to $45 an acre for a PLC payment for next year. Now this dropped a bunch. Last month, this price estimate was $320, and this payment would have been over $67. I think I had last month. So as this price moves, it's going to change the potential for these PLC payments. But keep in mind, if the price stays where it's at or goes down, you're looking at the potential to get more PLC money for next year. So you've got your crop insurance providing downside price protection. You've got PLC also providing some downside price protection. So maybe you don't have to panic and sell into a down market. Wait for the rallies to price. But if the market goes back down, then you know you've got some protection. For wheat, right now forecasting a 90-cent payment or about $30 an acre. Cotton seed right now, USDA forecasting about an 8.5-cent payment next year, which would give us over $120 an acre. Soybeans, as of right now, would not be getting a payment next year. Right now, the forecasted price at $8.50 is a dime above the reference price, so PLC wouldn't be paying anything for next year. I know a lot of us signed up our beans into the ARC program, hoping that we might get a 19 payment, which looks like it's going to be the case in some areas. We were concerned that what if the bean price went down, then PLC, might pay and we wouldn't get a payment. As of today, that's not the case. So next year, by I think March 15th, we're going to have to make a decision again for the 21 year. So we've got a lot of time to talk about that, but that's going to be an important decision you make relative to your 21 crops and how you're managing price risk. And as of today, I'm probably leaning heavily towards the PLC program for just about for every crop, because we're not going to get a chance to look back at the production like we did this last time. Remember, for the 19 crop, we didn't have to sign up until the end of the summer, so you got a chance to see what the crop was going to look like. Going forward for 21, 22, and 23, you're going to have to sign up before the crop gets planted. So if prices continue to linger in these low ranges, I'm probably going to put all my crops in the PLC program, but we'll talk about that down the road. So in closing, we've got some things coming up. July 15th, what's that, 3 days from today? 2 days from today, we got acreage reporting deadline as well as production from last year. That's at both the FSA office as well as at your crop insurance agent. August 12th is the next USDA WASDA report. And the day after that, we will have our next afterMATH webinar. We do anticipate USDA could change the production numbers in that report. So that'll give us something to talk about besides demand as well. The 15th is when we start setting our base prices for 21 crops for winter wheat, as well as margin protection insurance for corn, soybeans, and spring wheat. The end of the marketing year is August 31st. And then September 11, we'll have another WASDA report. And then on the 14th, we'll have our afterMATH webinar. And then September 30th is the final day to buy coverage for winter wheat, as well as the margin protection for those crops for next year. So we've got quite a few things coming up here over the next few months. So with that, just a quick reminder of all of the different marketing services that we have. I do an opening bell call every morning. I have the market report email at night. This webinar called the afterMATH. Every couple of weeks, I'll record a podcast called Kicking Up Dust. We have our Crop Scout Insights, where we have numerous agents from around the country that provide comments about crops in their areas. Very, very beneficial to me, and hopefully it is to you as well, to see what's going on in different areas of the country. The Revenue Perspectives is a newsletter that we just started a month ago that we send out on a monthly basis on Crop Report Day. And then we also have our prices that we keep on our website as well. All of this is available through the NAU Country website. You can go to the marketing tab and click and subscribe to any of these that you'd like. Also want to mention the Field Insights that we have available. Field Insights is a great tool to have on your phone. Gives you weather, but it also gives you climate information, precipitation, gives you wind speed forecast, you can sign up to get hail alerts on your farms. Just a great, great tool to be able to have, and we're thrilled to be able to offer that, and for you to be able to get it. You can get it on your computer, you can get it on your phone, you can get it on your iPad, whatever you use. Just a great way to get weather information, and it doesn't cost anything. So with that, I certainly thank everybody for tuning in this month, and appreciate the opportunity to visit with you, and we'll record this as well. We did record it, so if you want to listen to it again or check back, please do. And check it with the market report emails every day. If these markets are moving around, that's where I'm going to be putting in some ideas as far as marketing goes. And so if you're looking at some advice or looking for another party that an opinion, certainly check that out, and we'll have that on there. So thanks for joining us, and hope you have a safe and good month ahead.